Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, we have our fancy little notepad that we use for financial planning, and I see that you put a range of dates.
Yes.
What do those dates signify?
1940 through 1981. I became interested in this particular 41-year period because of a conversation on the Bogleheads forum where people were talking about long-term bonds, 30-year bonds. And as you know, long-term bonds, well, we don't really recommend them. We don't have them in our clients' portfolios, and they're very risky and can be very volatile. So this was a terrible period for long-term government bonds, even treasuries. So I was wondering to myself, how...
So this was a bad performance?
Yeah,
period?
terrible,
Okay.
terrible,
Okay.
41 years. But then I thought, well, we don't have data on every single asset class, but we do have data on intermediate government bonds and also treasury bills,
Okay.
going back long time. So we certainly have it from this time period. So I decided to look it up, and I said, how well do intermediate government bonds do? Because even though our portfolios tend to the short side, still intermediate period government bonds, which are 10-year bonds, are not usually considered to be too risky. They're not too volatile. A lot of financial advisors will say, well, intermediate treasuries, that's a very low risk asset class. So I wanted to find out, since this was a terrible period of time for bonds, which I had already known from doing other kinds of studies, just how bad was the performance from this 41 years for bonds? Okay.
And bonds are portrayed as conservative fixed.
Yes, conservative investments.
Okay.
Right.
Thank you.
Yeah, exactly. So for 41 years after inflation, the cumulative return for 10-year treasuries was negative 42%. Cumulative return.
Wow.
That's pretty bad.
So
That's incredibly bad.
Good. So
How do you lose 42% for 41 years after inflation? Simple. Lose a percent a year or so.
yeah, that's right. So we lost 1% per year.
You're right, exactly.
Okay.
For this 41 years, it's not like there was some terrible year where there was the Great Depression for bonds.
Right.
It didn't happen like that. Just slowly but surely, you lost 1% per year to inflation. How does that happen? Simple. You start off with very low interest rates. And when you have very low interest rates or very low yields on the bonds, as inflation goes up, they just never quite caught up. And then finally, in the 1980s, the yields on bonds did get higher than inflation.
Right.
And then when inflation went back down, those yields stayed higher than inflation in much the same way. So from 1980 until the present, I don't have the exact numbers, but bonds had very high returns. But for this 41 years, and this is a long time to be losing money. 41 years is a long time. In particular, it's a long time to be losing 40%.
Right.
Over all these years, the problem again was that interest rates started at a very low. They started very low. So when I looked at this, I said, well, today we have a benefit that investors then didn't have. We have Treasury inflation-protected
Right,
securities.
right.
So you can buy bonds that are guaranteed to, in some sense, keep up with inflation. So I looked up on Bloomberg today, and I found out what is the current real yield, because a Treasury inflation-protected security gives you the real yield plus the rate of inflation every year. Yeah, pretty simple. Okay, what's the real yield for a 5-year Treasury right now? Negative 0.32%. The past in bonds doesn't predict the future, but yields now do predict the future. I can predict exactly what this TIPS is going to make in real terms over the next 5 years per year. Negative 0.32%.
Okay.
So if there was ever a time recently that it won't be this bad, because this is, like I said, about 1% per year. But if there was ever a time when you could conceivably be looking at a long period of poor performance for bonds or other safe investments relative to the rate of inflation, now when bonds are explicitly at a negative real yield, when you buy them, you are actually getting a negative yield. Now's the time.
Okay.
And do I think that people should not invest in bonds or something like that? Of course not. Bonds are still a part of a diversified portfolio. They still tend to go up when stocks go down, which is the primary thing you want to have when you put things together in a diversified portfolio. It's still the case that for long retirements, the safe withdrawal rate is the highest for portfolios that include both a globally diversified portfolio of stocks and some bonds. But for those people who are looking at the recent stock market turmoil, or the last 10 years of stock market turmoil, and thinking that the answer is to put all of your money in safe investments, you should understand there was one 40-year period in history where you lost almost half your money with that strategy.
And the question I would guess, and you can't answer it because we're trying to predict the future,
Right.
is the current low interest, and you just said negative 0.33%
Right.
per year. It seems like history has a chance of repeating itself.
Well, the thing about predicting the future is you can never predict what stocks are going to do, but you can predict what bonds are going to do over the time period that the bond is. And right now we are certainly at a period of low interest rates. I would never think that this is going to recur, but people should understand if it happened in the past, it can happen in the future. That's why we look at the past. It doesn't predict the future, but things that happen in the past could happen. And you cannot simply think that there's something out there that's a safe investment.
Right.
Nothing is truly safe. It's not really the way the world works. In fact, if you're retired and you're taking money out of your portfolio, you're a little bit safer concentrating on putting things together that don't go up and down at the same time together. That's what really matters, especially because, stocks did fine over this time period.
My guess is if you had the diversified portfolio for the same time period, I don't think we have the numbers available, but you're going to make a positive return on inflation.
Yes, very positive return.
Yeah. So so when you hear pundits say that intermediate bonds are the safest investment or short-term bonds, it's not always true.
Not. It depends on who you are.
All right. Thanks, Laura. I appreciate it. Well, thank you for watching this episode of Erickson TV, and we'll see you next time. Bye
See you next time.